You may have seen the news that recently the stock market has almost had its worst January ever in the NASDAQ, and the S&P 500 recorded its weakest January performance since 2009. That's a little concerning. And this of course has a lot of investors concerned about where exactly the market is heading. So in this video, I want to talk about what exactly is fueling the chaos in the stock market right now, if the market will continue crashing or is it going to start heading back to all-time highs, and then finally, what you can do to benefit from all this, as in make some money, baby. For starters, let's talk about what exactly is fueling the market volatility right now. Starting with the elephant in the room, Facebook, or excuse me, Meta. Meta recently experienced not only one of the worst stock plunges in its company's history, but also ranks as the worst drop in value in stock market history, losing 26% of its value in less than a day. Now, Facebook isn't solely responsible for all the chaos happening in the stock market right now, but they do represent a much larger problem, which is overvalued stocks and specifically tech stocks. You see, after the 2020 stock market crash and during the coronavirus pandemic, companies were forced to have employees work from home because of the lockdowns, and as a result, tech stocks grew massively. In the 2 years following the start of the pandemic, from the beginning of 2020 since the beginning of 2022, the stock market is up over 100%. Now, this of course begins to raise some concern about whether or not the stock market is overvalued and due for a pullback. Consider this: the top 5 stocks in the S&P 500, which is an index that represents the entire US stock market, are all tech stocks, and these top 5 stocks alone make up over 25% of the entire stock market. It makes sense then that if any of these 5 stocks drop, that it's going to have a massive impact on the entire stock market and also have a ripple effect on other stocks in the same sector. For example, we saw other tech stocks like PayPal and Snapchat take a nasty fall as well. Now, did PayPal's stock drop specifically because of Facebook? No, but also, yes. You see, the stock market, as much as really smart people would prefer you to think, is actually driven primarily by human emotion. We saw this firsthand with what happened to GameStop in early 2021, when shares went from a low of $4 to a high of $325 in less than a month. It simply doesn't make sense, but when do human emotions ever make sense? And so when a huge company like Facebook loses 26% of its value in less than a day, that will cause investors to be very concerned and on the defense about other stocks in their portfolio doing the exact same thing. And when you mix this concern with other uncertainties happening in the global economy, the stock market will respond. And so on top of the overvalued stocks, you've got things like rising interest rates due to inflation, which is causing the stock market to react. The Federal Reserve, aka Jerome Powell, has signaled that they will begin increasing interest rates in March. And by the way, when you hear the news or people in general just talking about the interest rates increasing or decreasing, they're specifically referring to the federal fund rate, which is basically the rate in which bigger banks lend money to smaller banks, who then go and lend money to you and I, the consumer. And so whatever is happening with the federal fund rate, whether it's increasing or decreasing, that's going to have a far-reaching effect into all the other interest rates in the economy. How exactly does this affect you? Well, the moment interest rates begin increasing to bring down inflation, the cost to borrow money becomes a lot more expensive. For you and I, the consumers, the interest rates on your credit cards, personal loans, car loans, mortgage rates, all that stuff increases. This of course will decrease spending, because who on earth would want to pay more money to spend money? Let me give you an example. Would you rather take out a mortgage at a 3% rate or at a 7% rate? Just to give you some perspective, a 3% rate on a $200,000 30-year fixed rate mortgage means you'd pay a little over $103,000 in interest over the lifetime of the loan. But a 7% rate on those same exact terms means you'd pay a whopping $230,000 in interest over the lifetime of the loan. And so obviously it makes sense that when interest rates are lower, people are spending more money because the cost of borrowing and spending money becomes cheaper. But when interest rates increase to combat inflation, then less people are spending money. But how exactly does this affect the stock market? When consumers are going out and spending their money, where exactly are they spending it? At businesses, right? Consumers buy things from businesses. But if interest rates are increasing, which triggers people to spend less money, then it means that businesses are also earning less revenue. And when a business earns less revenue, it triggers an entire new set of problems. For example, companies can no longer afford to pay salaries, and so jobs are cut, which means unemployment rates rise. And because of the lack of revenue, it also means that businesses have less profit, which means they can't grow or expand as much. And this is a problem for investors, because in order for investors to make money in the stock market, businesses must be profitable. And if a company is not yet profitable, the only way they can expand their business is by what? taking out loans, borrowing money. They borrow money to hire people, purchase equipment, open new locations, and make other investments into the business to expand. But if the interest rates are increasing, just like consumers stop spending money, so do businesses. And so all of this culminates into what we've been seeing over the past couple of weeks in the stock market. And so in addition to these concerns, there are other things happening in the world that will create market volatility. For example, company earnings season has officially begun, which has a tendency to create volatility in the markets. Omicron numbers continue to complicate things for the economy, causing staffing shortages and continued global supply chain issues. And tensions overseas are causing concern that may potentially have implications on the US stock market. And so with all of this chaos happening in the stock market, how exactly are you supposed to know if the stock market is going to go up or down and when the right time to buy is? Well, for starters, nobody knows exactly what the stock market will do. And if you know anybody or watch anybody who claims that they know exactly what will happen to the stock market in the future, then I would avoid that person at all costs. Or at least just take what they say with a grain of salt. Well, no, not even a grain. No grains of salt. Don't take any grains of salt from anybody pretending that they can predict the future of the stock market. Now, with that being said, okay, there are tools that we can use at our disposal that can help us to better understand where the stock market could go potentially. Yes, interest rates are increasing. There will be plenty of volatility in the markets over the next few months. We may even see another 10 to 15% market correction. I want to bring your attention to this chart right here though. This chart represents what the stock market has done over the last few interest rate increases over the last couple of decades. As you can see, although the market doesn't follow the exact same path with every rate hike, that would simply be impossible, there is a sort of pattern in all the chaos. And the pattern is that yes, after interest rates increase, the market does become choppy. You can see that on the left side of the graph here, when the Federal Reserve announces rate hikes, things become messy. But on the right side of the graph, after some time has passed, after emotions have settled, things go back to normal. The stock market rises. And this white line here represents the current state of the market. So you saw the graph, I'll let you be the judge. But just understand that all of this stuff happening, rising interest rates, inflation, unemployment rates rising, all of this stuff is completely normal and it's all a part of the economic cycle. But that does leave us with the question, how exactly can you make money from what's going on right now? I've got 3 ways. First, do absolutely nothing. If you have an investing plan, for example, perhaps you're planning on retiring in the next 10, 20, 30 plus years, then just simply stick with that plan. Don't forget, time in the market always beats timing the market. Think about the investors who tried timing the market back in the 2020 stock market crash, when the stock market fell over 30%, wiping out 3 years of gains in just one short month. I'll be the very first to admit it, that can be scary, but for investors who jumped out of the stock market thinking they were outsmarting the market were very quickly devastated when they realized that in just a few short months following that massive crash, the stock market had already recovered its losses and by the end of the year was up 65% from its low. Time in the market beats timing the market. Yes, there is a lot of volatility in the market right now, but if you're looking at what the market is doing on a day-to-day basis, it's a roller coaster ride. But don't lose sight of your long-term plan and just continue holding. At least that's what I plan on doing. But of course, as they say, this is not financial advice. Second, if the market does continue to fall, just consider it a discount, a clearance. All those stocks and ETFs that you've been investing in over the last few months, well, guess what? You can still keep on buying those stocks and those ETFs, but this time you can buy them at steep discounts. This is why you'll see hedge fund managers and billionaire investors often buying up loads of stocks during a crash or correction. Now, the third way that you can make money with all of this chaos going on is actually a more conservative approach, but has proven to be far more successful for a majority of investors over a long period of time. And that is by implementing a dollar cost averaging strategy into your investing. Dollar cost averaging, or DCA, is when you invest your money in equal portions during regular intervals, whether the stock market is up or down. You still invest your money, but spread out over a long period of time. For example, instead of investing, say, $1,000 at the beginning of the year into your favorite ETF, you would simply divide that $1,000 by 12 months and then invest that much every month over the next year. Dollar cost averaging essentially reduces your risk in the stock market because it ensures that you are always investing your money regardless of how turbulent the stock market is. By using the dollar cost averaging strategy, you avoid the temptation of trying to time the market, which typically ends very poorly for most investors. Okay, so that's all I've got for you in today's video. Hey, thank you so much for watching and sticking around to the end. It means the world to me. I think you're amazing. And as always, I will see you again very soon. Take care.